Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing CD Projekt stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. CD Projekt is a Polish video game developer, publisher, and distributor. The company is headquartered in Poland and was founded in 1994. It went public in 2017 and currently trades on the pink sheets. The company is known for the Witcher series. It began by translating major video games into Polish. It was working on the PC version of Baldur's Gate: Dark Alliance when Interplay experienced financial difficulties. The game was canceled, but the company reused the code to make The Witcher. It also started a website called OTGLY.com to help players find old games. GOG stands for Good Old Games. It merged with Optimus in 2009. By 2017, it was the largest publicly traded video game company in Poland. By 2020, the largest in Europe. Let's get started with the model. This is a mid-cap company, 6 billion market cap. They're trading at $15 a share, and they have 401 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see the company has positive free cash flow every year except in 2019. Net income is the profit and loss on the income statement. It's revenue minus expenses. And they have positive net income every year. Revenue is the sales for the company, and that did dip in 2018 from 2017. It grew a lot the following 2 years. This is the company's income statement. All the numbers are in Polish złotys, but everything on my Excel spreadsheet is converted to US dollars. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue, and the difference is the gross profit, and their gross profit peaked in the trailing 12 months at 450 million. Then below that is operating expenses, then operating income, and they have positive operating income every year, peaking in the trailing 12 months. The company doesn't have any debt. The 9 million is the interest they received on their investments. Then below that is pre-tax income, then taxes. And the bottom line of the income statement is their net income. And they have positive net income every year, their highest in the trailing 12 months at $250 million. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. Operating cash flow is a better indicator of a company's financial health than net income, because net income is your accounting profit and loss. It's not actual cash. And they generate a lot of operating cash flow each year. They almost doubled from 2019 to the trailing 12 months. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. And they have positive free cash flow every year except in 2019. Since the company generates positive operating cash flow, they're not using any debt or equity financing to run their business. This is what you want to see when you invest in a company that can generate a lot of cash and run its business that way. That's how the stock grows over time, and eventually if the cash flow becomes consistent, they can start paying a dividend. Let's look at the capital structure. They have $281 million of equity. They have 0 debt, so they're 100% equity. And their WACC is 5.85%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 9.8 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $8.3 billion. We divide that by 401 million shares. And we get a calculated stock price of $21. They're trading at $15, so they're trading at a 28% discount. It's a buy according to the model. Simply Wall Street values the company at $26, so they're saying it's even more undervalued. This is the stock price since it started trading on the pink sheets in 2019. It looks like it peaked at about $30, but it's been cut in half. The stock is trading at a nice discount relative to its all-time highs, also relative to my model and Simply Wall Street. And they have a low beta 0.46, so the stock moves about half the market. The stock has gone down 16% in the past 52 weeks, while the S&P 500 went up 40%. The 52-week low was $12, the high was $32, and the stock is trading below its 50-day and 200-day moving average, so it seems to be on a downtrend. About 100 to 200,000 shares are traded each day on this stock, and of the 400 million shares outstanding, 263 million are on float, and less than 1% of the shares are held by institutions. If you invested $10,000 into this company when it IPO'd, your investment would have been $17,000 at one point, but if you're still holding on, you'd be at $8,700 today. That's a 10% annual loss. 3 of the top 5 shareholders are individuals connected to the company. Let's look at the financial ratios. The average PE in the market's 9, the median is 14. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 92.9, so investors are paying $93 for $1 of earnings. Price to sales is stock price over sales per share. They're at 36.5. Price to book is stock price over book value per share. They're at 21.4. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities on the balance sheet, and they have 281 million of equity, 115 million of tangible equity, because they have some intangible assets on their balance sheet. ROE is net income over equity. They have a really good ROE at 23%. Current ratio is current assets over current liabilities. They can cover their current liabilities 1.5 times. And the company does seem to be well capitalized. They have $30 million of free cash flow and $61 million of working capital. So they have $92 million of funding. Most of their current assets are in cash. The best way to look at ratios to compare them to companies in the same industry. I did videos of 4 companies in the same industry as CD Projekt. And if CD has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they don't have a good PE or price of sales. They are doing a little better on price to book just because one company has 100 and that's dragging up the average. They're doing fine in current ratio. They have a really good ROE, one of the best on the list. They have no debt, which is great, the only company on this list with no debt. But they're the smallest company at $6 billion market cap. So to summarize, I have them trading at a 28% discount. But what will make this company successful is its catalog of games and the success of those games in the market. They seem to be doing really well so far. They're growing their business and they're profitable. Plus they're doing this with no debt, which is impressive. I rank their free cash flows 4 out of 10, their revenue 6 out of 10, and their ratio is 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.